Well, first of all, welcome everybody to our virtual tax advisor masterclass series. This is intended to be a complete step-by-step guide to understanding the Canadian tax system and learning how to confidently navigate your annual tax returns. My name is Stacy Bartel. I'm a lifelong learner who's passionate about finding ways to help you build your wealth. Over the past 30 years, I've worked with our tax clients, educating them on personal tax situations, explaining why they owe money or get money back, and perform a deep dive on what deductions or credits they may have missed in the past. During this course, we'll be teaching you the ins and outs of how to best navigate the dreaded tax season. At the end, you'll be able to answer your clients' questions. Well, first of all, at the end, you'll be able to perform, prepare, and advise on income tax returns for yourself, friends, family, and clients. You'll be able to answer your clients' questions, recognize what you know, and also recognize when it's time to seek additional advice for the multiple situations that you will encounter that you don't have an answer for. The one thing that I've learned about the 30 years of income tax preparation that I've been doing is every year I educate myself and every year we learn. The government changes rules. There's thousands of different scenarios that we can incorporate. We can't possibly cover them all in here, but this will cover about 85 to 90% of the tax returns that you do have. Okay. What I can tell you is I do know that you'll feel confident with the knowledge you have learned at the end of this. This isn't the first tax training course that we've done. Most times we've been training internal staff with this, but we have over the past couple of years conducted training courses where we've successfully helped others go out and start their own businesses. Over the coming modules, we're going to break down taxes in a way that is simple, practical, and deeply relevant to your everyday financial life. Whether you're an employee, a business owner, a parent, a student, a retiree, or someone who is just looking to optimize your financial strategy, this masterclass will give you the clarity and tools that you need to control your tax situation. This course will consist of 3 weekly lectures, such as the one we'll be going through today, along with weekly assignments, quizzes, and an open question and answer lecture style where you'll be able to ask any questions that you have and have full access to our team at the end of every session. The classes will be recorded and available afterwards. However, we will not be available 24/7 for frequently asked questions. We will provide you with an email address that you'll be able to send questions to, so one of our instructors will be able to assist you off course hours. In this course, we're going to begin with what taxes are and how the Canadian tax system works. You're going to learn the structure of the federal and provincial tax system, how tax brackets really function, and why your tax rate changes from year to year. We'll talk about the difference between what is called a marginal tax rate and an effective tax rate, and why the distinction matters when making financial decisions. From there, we'll move on to one of the most important topics, employment income. Under employment income, you're going to learn how your T4 works, what your employer reports to the CRA, how withholdings affect your refund or tax owing at the end of the year, and why your paycheck rarely reflects your true taxable income. We'll break down taxable benefits, allowances, pension adjustments, CPP and EI contributions, and how all of this appears on your tax returns. We will continue on discussing we'll continue by discussing investment income, dividends, capital gains, and how the same types of investment income are treated differently based on your investment account, based on how your investment accounts are set up or registered. We'll then go and dive into tax deductions and tax credits, the core building blocks of every tax return. This is where you learn the differences between reducing your income versus reducing your tax, and why certain deductions like RSPs and home office claims can create much bigger savings than people realize. We'll explore refundable and non-refundable credits, provincial versus federal programs, and the most commonly missed opportunities Canadians overlook every year. And finally, we tie everything together with how to make the most of your tax return. This is where we show you how to reduce tax throughout the year, not just at filing time. You'll learn how to use RSPs, TFSAs, the new FHSAs, charity donations, dependents, tuition transfers, disability credits, and family level planning to build a long-term tax strategy. By the end of this master class, you will understand how the Canadian tax system works, know what income is taxable and why, recognize every major deduction and credit available to you. You'll be confident in interpreting your own tax slips, avoid the most common filing errors, and maximize your tax refund or minimize your tax bill with proper planning. Our course is designed to be completed by early February, giving successful students of our Masterclass 101 the opportunity to take Masterclass 201, which will cover more advanced topics like self-employment, rental income, employee expenses, including home and vehicle, as well as topics like sales tax and depreciation. So let's begin. Together, we're going to build your tax knowledge from the ground up. Today's class will be guiding you through the structure of Canada's tax system, its purpose, and how understanding it empowers both individuals and professionals. By the end of the session, you'll have a clear foundation of how taxation works, who must file, and how strategic tax knowledge can be used for smarter tax planning. Did I miss a slide here? Let me back up. Okay. Canada's tax, so we're going to get into a little bit of history here. So Canada's taxation story begins in 1867, which was the Confederation of Canada. Early on, the government relied on customs and excise duties and taxes. Income tax didn't come until later. Introduced in 1917 as a temporary measure to fund World War I. Of course, as we all know, it never went away. The Canada Revenue Agency has seen many faces over the years. In 1999, the CRA became the Canada Customs and Revenue Agency, and later the CRA as we know today. Fast forward to 2025, the CRA collects roughly $600 billion annually. It employs over 50,000 people. Oh, I should be clicking on here. Sorry about that, guys. Okay. It employs 50,000 and employs over 50,000 people. The Canada Revenue Agency, or the CRA, is the federal body responsible for administering the Canada's tax system. It enforces the Income Tax Act and the Excise Tax Act, and several other pieces of legislation on behalf of both Parliament and the provinces. One thing that makes it important, and you must understand this, one distinction is very clear, is that the Canada Revenue Agency, the CRA, does not create tax law. The law itself is written by Parliament through the Income Tax Act. The CRA's role is simply to interpret, apply, and administer those laws. And because the Income Tax Act is complex, the CRA must interpret how the rules apply to real-life situations, deductions, credits, business expenses, benefits, and more. However, the CRA interpretation is not always correct. Their view of the law may not match the actual intent or wording of the Income Tax Act. When this happens, taxpayers have the right to challenge the CRA's position. This brings us to the distinction between the CRA versus the Tax Court of Canada. As I mentioned before, the CRA has, I went one slide too many here. Okay, just let me kind of catch up on this. So as I mentioned before, the CRA has a position to interpret taxes. However, they're also a collection agency. And the best way to explain this is they are contracted by the Government of Canada and 9 provinces and 3 territories to collect tax on behalf of them. They collect GST, HST, and they also administer benefits. Like any other independent agency of the Canadian government, which is what the CRA is, the CRA has a mandate to be profitable within itself. And they're given a budget as to what they are allowed to do and expectations on what they need to generate in taxes. So therefore, they may have internal interpretations of the Income Tax Act that don't necessarily match what the federal government intended when they first put that out. And we're going to talk about how that all works. So, I think the first thing to discuss here is the CRA's mandate is really threefold. It's to ensure the compliance with Canada's tax laws. It's to collect the revenues needed to fund government programs and to deliver social and economic benefits efficiently. It also has a service commitment to taxpayers, providing education, accessible support, and fair treatment under the Taxpayer Bill of Rights. The Taxpayer Bill of Rights outlines 16 core rights guaranteed to every Canadian taxpayer. These rights protect your ability to interact with the CRA fairly, respectfully, and transparently. Among the most important are the rights to pay only what you owe under the tax law of Canada, to receive complete and accurate information, to appeal or object to a CRA decision, and to be treated professionally and courteously. In 2025, nearly all Canadians need to file an annual return. Individuals must file if any of the following are true. You're self-employed or have rental income. If you have not remitted enough tax to cover your tax bill, or in other words, you owe money to them, or if the CRA sends out a letter demanding you to file a tax return. Tax returns have deadlines. Now, these deadlines, with COVID coming around, during COVID, a lot of people missed their deadlines. The CRA, and I'm just going to talk a little bit about history here, the CRA and the Government of Canada allowed extensions and delays in order for people to file tax returns. As a tax preparation company, what we have found is that it created a lot of tardiness with a lot of Canadians. Canadians that were used to every year I have to have that tax return filed by April 30th, all of a sudden it became less important. We find as a team that we are spending way more time filing tax. We prepare way more taxes after April 30th than we ever have. And we spend a lot of time filing multiple years at one time. Understanding that missing those deadlines can be costly to taxpayers. So the deadlines are still important, and it's important to make sure that our clients understand the importance of them. So individuals must file their tax returns by April 30th. If you are self-employed, you have until June 15th to file your taxes. However, what's really important is that all monies due to the Canada Revenue Agency are due by April 30th. So even though your tax return isn't required to be filed until June 15th, if you haven't paid enough tax by April 30th to cover your tax bill, they will start charging you interest as of May 1st. Penalties will take place as of June 16th. So there is that 45-day filing period where You will be charged interest if you owe money, but there are no penalties. Penalties kick in after the late filing deadline of June 15th. Corporations have their 6 months from their year end in order to pay their taxes. Similarly, they only have 90 days to pay their tax bills. So while they have a 6-month filing period, they have a 3-month payment period. And this is where, as we go through the course, we will be talking about tax installments and how they work. And that's, because you can ask yourself, hey, if I'm self-employed, how do I know how much money I owe in tax until my tax return is completed? Well, this is where they start looking at historical data and say, well, and the CRA has a requirement for you to make installment payments or payments towards your tax bill 4 times a year for those who do owe money for a continuous period of time. Missing deadline penalties result in a minimum of 5% on unpaid balances, plus 1% added every month after. These penalties progress based on how late you have filed and the frequency of your late filing history. The second year of late filing, these penalties increase to 10% and 2% every month. So just to give you an idea and explain how this adds up, my tax return is due April 30th, 2025 for the 2024 tax year. I chose not to file my tax return in 2025. I let it sit and I have not filed it yet. This year I'm going to come in and I'm going to go into O.B.S. Tax Services, and they're going to file my 2024 and my 2025 tax return at the same time. Now, what happens in that situation is, because my tax return, let's say that the filing is done in April, the penalty for my 2024 will be 5% of the balance that I owe as of May 1st. June 1st, there's another percent. July 1st, another percent. August 1st, another percent. So on and so forth until April 1st. They've now added another 11%. I now have a 16% penalty, plus any interest. Now, what is the penalty? The penalty is based on any amounts owing to the government. And this is important to understand, that the penalties exist. However, they won't be monetized if the government owes you a tax refund. If you owe them money, they will charge you that. Right? So let's say that they owed me a refund. I don't have a penalty and I don't have to pay any interest. No problem. They file my tax return for 2025 by April 30th, 2026. Everything is good. And I get money back. Now, 2027, I look at it and I say, well, you know what? I don't want to go and file my taxes on time for 2026. I'm going to do what I did last year. And I'm going to file my taxes every 2 years because it's kind of a pain and the government owes me money. It's no problem. So 2026, I don't file my taxes by April 2027. 2028, I go in and I file 2 years worth of taxes, 2026 and 2027. Now, what happened is that my job changed and I went into a higher tax bracket. I quit making RSP contributions, and a few other things have affected my tax return. So in 2028, when my tax return is filed for 2026, I have a balance owing to the CRA of $1,000. Now, what are my penalties? If you look at the chart, there's 2 options. There's a 5% penalty plus 1% per month, or a 10% penalty plus 2% per month. The determining factor is how many times and what is the frequency of me missing my filing deadline. Well, if we go back in history, 2024, I filed late. I never filed it until 2026. Now, I didn't owe any money. However, I did file late. So, in the CRA's eyes, I am now a second time late filer. And even though I didn't owe money the first time, off of that $1,000, I have a $100 penalty for late filing on May 1st, and another $220 penalty, 2% per month for the 11 months that it took me to file it, because I didn't file till 2028. So now I've actually paid a 32% penalty on that money because things changed and I did not go get my tax return completed. So it's important to understand that this does stack on. Whether, even if you don't owe money, you are considered a late filer if you haven't filed by April 30th. Now, how long do they remember this and what the period is? In order to wipe the slate clean, you have to go 3 consecutive years to have your history erased and go back to that first year penalty. So it's always advisable to make sure that you are filing your tax returns on time every year. Right. Moving on. Canada's income tax system is a progressive tax system, meaning that as your income increases, only the dollars that fall into a higher tax bracket range are taxed at that higher rate, not all of your income. Let's explore this in more depth using a practical example. So imagine Sarah earns $70,000 in 2025. The first, looking at the chart here, so now in this course, we are going to talk about federal rates. We will discuss provincial rates as we go through, but because the students in this class could be from multiple provinces, we're going to focus on the federal rates, and we will top up with provincial understanding later on in the course. So, on a provincial basis, if we look at the chart, the tax rate is 14.5% in 2025 on the portion of taxable income of $57,375 or less. Anything over $57,375 up to $114,750 is taxed at 20.5%. So let's factor this in. The first $57,375 of Sarah's income is taxed at 14.5%, which is $8,319 in tax. The remaining $12,625, that's the portion from $57,375 to $70,000. Only that $12,000 is taxed at the higher rate of 20.5%. That adds another $2,588 to her tax bill. So her total federal tax bill at this point in time is $10,907, which gives her what we call an effective tax rate of 15.6. Okay? So, a couple of terms here. Marginal tax rate. That is, in these margins, what rate of tax do you pay on your income? Right? So that's 57 to 114, 114 to 177. So these are what we call marginal tax rates: 14.5, 20.5, 26, 29, and 33. An effective tax rate is when you calculate how much tax you have owing by the taxable income will tell you what your effective tax rate is. That's the actual tax. So in this case, where she's actually in a 20.5% tax bracket, her marginal tax rate is only 15.6. Okay, I do want to just talk a bit on, I'm just looking at my notes here, making sure I've covered everything. We've talked about marginal tax rate, average tax rate. We've talked about the fact that, so the way this progressive tax system works, and what's important to understand is, if you make more money, you may have to pay more tax, but it does not affect the money you already made. So best way I always explain this to my clients is this: how many times have you been at work and you'll hear coworkers, or maybe you've said this yourself, well, if I get a raise or if I get back pay or if I work overtime, it's not worth it. It puts me into a higher tax bracket and it just costs me money. Well, let's look at that. If your salary is $57,000 and you make $1,000 worth of overtime, the first $375 is still only taxed at 14.5%. And it's only the $625 that you're over that is taxed at that 20.5. And that's so important to stress to all Canadians. Most Canadians believe that if you move into that next tax bracket, you lose money and you're better off to be poor. That is not true. Even though you make more money and you may have to pay a higher rate of tax on that extra money you make, you're still going to always put more money in your pocket. Right? Now, one of the reasons why you may not realize that or see that is that it all has to do with payroll software and pay tables. It's not as prevalent as it used to be. Going back when I started doing taxes and bookkeeping, your payroll deductions were all calculated by a book. How much money did you make in this 2 weeks? This is how much money you take off in federal tax, provincial tax, CPP, and EI. It never focused on, well, how much money are you projected to make for the year and how much money have you already made this year? Payroll software has become way more intelligent and you don't notice such a hit on your paychecks, but if that excess money does put you into a higher range from 20% to 26%, you will see a higher note. The other thing that's important to understand is when we talk about CPP and EI in later classes, you'll see that most of the time why you're getting such a big hit is because of the CPP that they deduct and the EI that they deduct in the thresholds that happen in there. So there's a combination of everything, right? Last thing I want to note on here is if you take a look, there is a subtext note on number 1 on the 14.5%. Just to kind of explain why there's that subtext. Mr. Carney, once he was elected in, made a change to the income tax rate, and he moved the first marginal tax rate from 15% down to 14%. The problem is that did not take an effect until July 1st. So for the 2025 tax year, the marginal tax rate is 14.5% on the first $57,000. 2026, it will be 14% because you'll be paying 14% tax for the entire 2026 calendar year, not half of the 2025, right? Why do they do it that way? Well, if you think about it, it's way too complex to determine when did you make your money throughout the year. If they were to change the tax rates, now employers would be required to spit out 2 T4s every year based off of when the tax rate changes, and the completion of a tax return would be way more complex. So just to ease it out, that when the government makes changes to tax rates or tax credits, the changes will always happen on either January 1st or July 1st in order to make it simpler to file your taxes. Okay, moving on. Here's some provincial tax rates, and these slides are available in your Google Classroom. When we're finished this session, I'm gonna make sure everybody understands how to maneuver in their Google Classroom to find the information and find your homework. But at the end of the day, you'll take a look here. Newfoundland and Labrador have their own tax rates. 8.7% on the first 44,000, 44 to 88, right, is 14.5, 15.8, so on and so forth, and it goes up to 21.8, right, on income over $1.12 million. It's 21.3 on income over 564. So they have multiple tax brackets, which complicate their tax system. You'll see PEI has 5 different rates. Nova Scotia has 5 different rates. New Brunswick has 5 different rates. Ontario has 5 different rates. Manitoba has 3 different rates. Saskatchewan has 3. Alberta has 6. BC has 7. The Yukon has 5. Northwest Territories has 4. And Nunavut has 4. For the purposes of training, we will not be discussing PQ, the province of Quebec, and their tax system. Quebec is the one province that elects to collect their own provincial taxes. Which means that you file and complete a T1 general to the federal government, and you file and complete a Relieve 2 or a Relieve 1 to the provincial government for that. We will not be doing any training on Quebec taxes. Okay? So, moving into that, we're talking about income and taxation. And what is important to understand is that not all money is created equally. In the income tax system, different money gets taxed at different ways, or some money does not get taxed at all. And we're going to talk a little bit about that today, and we're going to get into that in different situations. So first of all, taxable income refers to all income that must be reported to the Canada Revenue Agency under the Income Tax Act. It includes wages, salaries, bonuses, commissions, tips. It also includes casual labor, self-employment income, per diems, honorariums. Anytime somebody pays you cash for doing something, that is technically taxable income. Even if they do not provide you with a tax slip at the end of the year, there is an obligation to do that. Okay? When we talk about taxable income, it also includes rental income, investment income such as dividends and interest, and the new digital or gig economy, things like Uber driving, freelance design, YouTube ad revenue, social media revenue, ad revenue, cryptocurrency trades, profits off of cryptocurrency, and we will go through all of that, right? But it is important to understand that even though you may not have tax slips for the income, you are required under law to report that and pay tax on it. Here's a prime example, and I'll bring this up because it's always been a pet peeve of mine. If you have money in a savings account in the bank is not required to issue you a T5 reporting that interest income unless the amount of interest that you earned is over $50 in the year. However, if you made $45 in interest, you are obligated and required to report that interest on your income tax return, even without the tax slip, and pay tax on it. Now, what's really remarkable in this is the Canada Revenue Agency always treats themselves different from any other legal entity in Canada. And I will say this for the fact that when we start talking about tax returns and we get into statute, right, limitation statutes and everything else, you can go back up to 10 years in some cases and apply for a change in your tax return. Providing you filed your tax return on time, if you go back and do an adjustment to your tax return and the government owes you money, they have an obligation to pay you interest on the money that they owe you. However, they are not obligated to issue you a T5 telling you that how much interest they paid you in the year. So I've seen cases where this gets really ugly. When we talk about going back, I'm just going to use a disability tax certificate. There's many people in Canada that would qualify for a disability tax certificate and the tax credits that come along with it. and they're not aware of it. When they become aware of it, the government will let you backdate that certificate up to 10 years based off of your medical reports. So if you go back 10 years, the average tax benefit of a disability tax certificate is about $2,000 a year in tax savings. Go back 10 years, that's a $20,000 chunk. Now, if the government has to pay you interest on that, the defined interest rates over the last 10 years have varied from 1% to over 5%. That $20,000 could be a substantial amount of, $1,500, $2,000, $2,500 worth of interest. They don't have to report that to you. But if you fail to report it on your income tax return, be sure that they know that they paid you that interest and they will penalize you for it. So we do need to make sure that we are aware of that. Okay? The CRA will assume that all income is taxable, unless it's specifically excluded by law. Even bartering or in-kind payments, such as trading services for goods, must be valued at fair market value and reported, not only for income tax purposes, but for excise tax purposes, GST, or provincial taxes. What do I mean by barter? Right? I sell bicycles, and I sell e-bikes, and I've opened up a new business in a small tourist town, and there's a magazine that goes out to all the tourists in the resorts. So I contact the magazine and I say, hey, you know what? I've got this new business. We'll talk about it as if it's like down in the States, you can go and you can just jump on bikes and use a credit card. They're called Bird or whatever else. So I go to this magazine and I say, hey, I've got all of these bikes and scooters that are sitting around town, and I want to promote it and let people know how the system works and whatever else. What would it cost me? And the publisher of the magazine says, well, hey, you know what? Those are actually pretty neat. I'd like to be able to use those. Instead of me charging you to advertise this, why don't I do an article on it and you give me a prepaid card so that I get $1,000 worth of free rides? Right? That is a barter. Under that barter system, you as the person selling the bikes has to report that $1,000 worth of income, and the publisher has to report the $1,000 worth of income for the magazine. Now, where it gets tricky and where we look at this, for me with the e-bike company, I'm gonna invoice out $1,000 for the services, but I'm also gonna get a receipt or an expense for $1,000 for my advertising costs. One washes the other, and I don't have to pay tax on the revenue, and I don't get a tax break on the expense because one offsets the other. However, there's GST that I should have been paying and probably PST, and that's one of the concerns of the government. The bigger concern is the publisher. The publisher is giving you a free service from his company and receiving a personal advantage which he is not paying tax on. So not only is he not paying tax on the sale or profit of the advertising, he is also receiving a benefit personally that he should be paying for with after-tax dollars. So we do have to watch for the bartering systems as well, right? For individuals, taxable income is calculated as your total income minus allowable deductions, such as RSP contributions, union dues, childcare expenses, or business expenses. The remaining balance is what determines your federal and provincial tax owing. So just to kind of wrap that up, we have an obligation to report all of our taxable income to the government. That's lines one, I'm going to call them 100 to 150, but it's actually 10,000 to 10,500 on your income tax return when we look at it. You have to report all of your revenue there. The next section in your tax return actually is where we're allowed to take money off of our total income to determine what our net income is, and then there's another section to determine what our taxable income is. However, we are obligated to report all of our income on there, right? It's also important to note that foreign income is taxable for Canadian residents, even if it's earned outside of the country. So, a couple of examples of how that happens, right? I went and I worked in the U.S. for a number of years, and I paid into a pension. I decided to come back to Canada, and I'm still receiving my pension from my U.S. pension board, or I'm receiving Social Security, but I live in Canada. Even though that money is not made in Canada, I have to report my worldly income on my tax return, regardless of where it is being made. Now, there's tax treaties and a whole bunch of other things that get complicated that come into play there. We'll briefly touch on them. That becomes in more advanced sessions. But at the end of the day, it's important to understand that you have to record your worldly income. Now, for those that are immigrating into Canada, you only have to worry about reporting your worldly income from the date that you arrived. So from the date that you arrived and got your work visa or your temporary residency status, that sort of thing, at that point in time, you only have to report your worldly income from that date. Anything from the day before you arrived in Canada would not be taxable in Canada and not be reported on your tax return. All right. Moving on. Tax-free income. Well, obviously this is the best income to receive, right? What is it and how do I get it? So, while most income in Canada is taxable, there are several categories that are specifically exempt under the Income Tax Act. Understanding these can help Canadians maximize after-tax income through legitimate planning strategies. Common forms of tax-free income include lottery winnings, gambling winnings, gifts, or inheritances, right? So lottery and gambling winnings, these are not taxable unless you operate as a gambling business. So if you are a professional poker player, that becomes a business and it is taxable. If you're the occasional guy that goes to the casino, it is not, or girl, it is not taxable. So that comes into what we call nature of trade, and we'll discuss that as we go through. Gifts and inheritances. Money or assets received from relatives or estates are not taxable to the recipient. However, the giver may trigger capital gains if appreciated assets are transferred. So what that means is, and this as a conversation about death tax, in Canada there's technically no death tax. Somebody passes away and leaves you an inheritance, you do not have to pay tax on any of that money. However, that person's estate may have to have paid tax on that if it was money coming from deferred tax sources, if it was from investments that received capital gains, real property. So they had a cabin that they paid $10,000 for back in 1980 and it's worth $500,000 today. The estate or the person giving it to you, even if they're still alive, may have to pay capital gains on what's called the disposition or deemed disposition, but you as the recipient do not have to pay tax on that. In 2009, the government introduced TFSAs, tax-free savings accounts. Now, a tax-free savings account is not necessarily just a bank account that you have at your financial institution. It could be also a number of investments that you have that are registered as a TFSA. When we deal with a TFSA, investment growth, dividends, and withdrawals from a tax-free savings account are fully exempt, which means that you never pay tax on it. FHSA withdrawals. In 2018, the government introduced an FHSA. What is an FHSA? It's a first-time home savings account. Again, it's an investment account where you can put money in. So now, I'm just going to back up a little bit. We will be talking about tax deductions down the road. So don't get too caught up in that and what happens. We have a whole 2 or 3 classes that talk about deductions and how different investment accounts are registered. However, for the purpose of this, if you have a qualifying withdrawal from money that was invested in a first-time home savings account, it is tax-free to you. You do not have, it's not a loan. You do not have to pay it back like an RSP home buyer's plan. You put the money in, it grows. When you go to take it out, you do not have to pay tax. It's one of the incentives that the government has introduced to try to make home ownership more affordable in Canada. Life insurance proceeds paid upon the death to the taxpayer's beneficiaries or estate are considered tax-free, right? However, depending on who the owner is and who the beneficiary is, there may be certain steps to get that out. So I'm referring to corporate-owned or trust-owned life insurance policies and that sort of thing. There are special rules that come into play with it. But for basic conversation, if you have a life insurance policy on yourself, or you have creditor life insurance, which would be, the bank's giving you a life insurance policy on the value of your mortgage or your credit card debt or whatever else. Something happens to you, the payoff of those debts or the payments that your beneficiaries receive are received tax-free. Certain government benefits are tax-free. Those benefits would be the Canada Child Benefit, GST or HST checks that are received 4 times a year. There was the carbon tax rebate that has now ceased to exist, but for a number of years there was a carbon tax rebate that was tax-free. Some provincial climate or family benefits are also not included in taxable income. It's important to differentiate between tax-free and non-reportable. Some tax-free amounts like TFSA income are excluded entirely from tax returns. Others, like certain government benefits, may still appear on tax slips but remain non-taxable. Specifically, or not specifically, but a majority of where we would see that is when we look at scholarships and bursaries received by students, right? If students that receive scholarships or bursaries are generally tax-free based on the student activities. If the student is a full-time student in post-secondary education, then there's certain then the income becomes tax-free. You still have to report it on your tax return, and then there's an exclusion for it, but you do need to make sure that that everybody is aware of it, right? There's also workers' compensation or disability benefits that are exempt in many cases. And another one that we have in here would be social service payments, welfare. Those are also tax-free. Okay, last but not least would be 50% right now, currently 50% of any money made in capital gains are also tax-free, and we'll talk about that in the investment modules. As you can see, right, so let's talk a little bit more about taxes. As you can see by the chart here, from February 8th to November 10th, 2025, based on the filing of 2024 tax year returns, here's some interesting information. 3,914,000 Canadians filed their tax returns and received checks for their refund. The total value of those checks were 8,377,000, or the average taxpayer receiving a refund received $2,000. Moving over to direct deposit with refunds, over 15 million Canadians received their refunds from direct deposit, total of $36 billion, and that is as well as an average return of 2%. And these are CRA statistics available on their website. So what does that say? The average taxpayer getting a refund receives $2,000 a year in income tax refunds. Now, is that a good thing or is it a bad thing? As a wealth management advisor and as a financial advisor, I'm going to say that that is a bad thing. What that means is, and you'll see more in this course, but really what that means is that the taxpayers are lending money to the federal government to the tune of $2,000 a year and not receiving interest on it. Now, getting into this, I probably should have prefaced this by saying over 90% of the tax refunds that are issued to Canadians are not based because the government of Canada is giving you money. Tax refunds, the true definition of it is, it's a refund of overpayments made to the government based on your actual taxable income. So if you're getting $2,000 back, what that really means is that you overpaid the government $2,000 throughout 2024, and you waited until April 2025 to get that money back, lent it to them tax-free. So overall, tax returns are not a good thing, right? Let's talk about tax owing. A total of 8 million Canadians owed money to the government at the end of the tax year. They owed a total of $70 billion. That is an average of $9,000 per person. So, what type of people would this be? This would be self-employed individuals. This would be a lot of retired individuals do not have enough tax deducted from all of their investments and income sources, and they end up owing money at the end of the year, as well as people who have rentals or have received large profits from capital dispositions, right? So you've had a cottage, you've owned a cottage for 35 years, you now sell it because it's not your primary residence, it's subject to capital gains and you have to pay tax on it. That equates to a huge tax bill. So when you owe money, you normally owe a lot. When you get money back, the average Canadian gets back about $2,000 a year. Now, this is based off of 2024. I've looked at these stats since, I'm going to say since 2007 annually, and that amount increases every year, right? Which means the government's holding on to more and more of Canadians' dollars and giving it back to us at the end of the year. Now, a lot of people like tax refunds, but it's unfortunate because the people who like their tax refunds, they like their tax refunds so they can pay off their credit card that they're paying 19% interest on. Well, if you take that $2,000 throughout the year, it's about $157 a month you could have added to your credit card debt and paid less interest. So just on a wealth management standpoint, tax refunds are not really a good thing. Okay. Now, how do we avoid huge tax bills or huge tax returns? Well, the way to do that is to complete a TD1 form. Now, this is the TD1 form from 2025, and we will talk about this, and you will be filling one out for yourself down the road to understand what it is. But basically what it is, it's one of the most important payroll forms in Canada. What it tells our employers, it tells them what tax credits we are either entitled to or not entitled to. And it asks the employers to take those into account. So as we go further down the road, we're going to start talking about tax credits, tax deductions, how they work, and this form will make a lot more sense to you, but I just wanted to bring it up and say that this is something that's very, very important because it determines whether you get money back or not. Unfortunately, most employers do not even understand the form themselves. So when they give it to their employees, the employees say, how do I fill it out? And they say, I don't know. Draw a line to the bottom, put X amount of dollars in, and hand it in. Right? There used to be amounts that were pre-filled in these forms. The government doesn't even pre-fill them anymore, hoping that you're not going to fill it out right and you're going to give the government more money every paycheck that they'll be able to give back to you at the end of the year. Okay. What's important to understand is there's also provincial versions. As I showed you before, each province has different tax rates. So everybody should fill out one federally and provincially to make sure it's correct, especially if there's extra deductions that come in on these forms or extra credits that come in on these forms. Taxpayers should always update them for change when there's changes in the family or when there's income changes. If you start a second job, they become crucial. So if you have a side job, they become crucial, right? The form is available electronically and can be filled out electronically and submitted. Now, start talking about taxes. The main tool of the income tax return is what we call a T1 jacket. It's officially known as the T1 General Income Tax and Benefit Return, and it is the main form used by individuals in Canada to file their personal taxes each year. It acts as a summary document. So really what happens is it pulls together all of your income deductions, your income and deductions to determine your taxable income. Those income and deductions are transferred to schedules. Federal tax schedules, federal credit schedules, provincial tax schedules, provincial credit schedules, and a multitude of other schedules. Those schedules are all used to determine how much tax you owe or any refunds that you're entitled to from refundable tax credits. And then the information on those schedules are then transposed back to the T1 jacket to wrap things up to give you an all in all, this is what you owe, this is what you get back. So the T1 jacket becomes very important, but understand that each individual taxpayer will have different schedules to complete based off of their situation. Really, what we want to do is we want to think of the T1 jacket as a cover sheet for your personal tax return. Every line number corresponds to a specific type of income, deduction, or credit as defined in the Income Tax Act. For example, line 10100 is your employment income, and that comes from box 14 on your T4 slips. Line 10400 is other income, which would be tips, honorariums, or casual work that really is $500 or less. Any casual work, casual employment where you've been paid and your income is over $500, whether it's cash, e-transfer, check, or barter, if it's over $500, you're technically required to complete and fill out a statement of business activities as self-employed revenue. We have, then there's deductions that come through in the second section's line 21200 is RSP deductions. gives you line 2600 as taxable income, so on and so forth. And ultimately, the line that's not on the screen here, but the most important line is line 43500, which is the total amount payable to the government in income tax. Okay? Now, notice I said the total amount payable to the government. I didn't say how much you owe, and I didn't say how much you are getting back. The most important thing to understand as a taxpayer in Canada is that everybody pays tax. Line 43500 will tell you how much tax you actually had to pay based off of your income for you to determine your tax rate, your effective tax rate. The 437, 439, I can't remember what the lines are. Those, after we look at what your total tax payable is, then we look at your credits. How much have you paid? How much money was deducted from all of your income sources and sent directly to the government on your behalf? How much did you send off in installment payments? Are you entitled to any educational or provincial refundable tax credits that will go towards that? There's also, so there's a number of other credits that get applied to it to determine whether you owe them money at the end of the year or not, right? I believe that it's important that every Canadian knows how much money they actually owe in tax. When we go through how we work with our clients and explain to our clients their tax returns, we talk about that. And in some cases, we almost give people heart attacks, letting them know that, they owe for 2025 $22,400. Now, the fact of the matter is maybe they had $25,000 deducted and they're getting a $500 refund, but they owe $24,500. That's how much money the government is taking out of their pocket. So it is important to understand. Okay? Really, lines 40100 to 43500, that's your income tax deductions. This is where we really want to focus on the importance of personal information accuracy, maintaining and keeping records, and understanding what deductions are available to lower that line 43500 as much as possible. The lower line 43500 is the higher your income tax refund is, or the lower your tax bill is at the end of the year, right? So we also have provincial forms. As I said, when completing your federal tax return, you must also calculate your provincial or territorial tax. Since each province has its own tax brackets, rates, and credits, the CRA administers provincial taxes for every province except for Quebec, which has its own separate agency. The T1 jacket also includes information from your provincial tax schedules. The CRA, Canada Revenue Agency, administers and collects tax on behalf of the 9 provinces and 3 territories, thus saving taxpayers the time and effort of filing 2 tax returns. Right? Where do we have issues with people filing 2 tax returns? The United States actually files 2 tax returns. Other than the 4 states that do not have a state tax, every other American has to file an income tax return and send it to the IRS, and another one that gets sent to their state tax department. And they have to write 2 checks or get 2 refunds and manage the notices of assessment from both. And in the States, they really don't send out a notice of assessment, which makes things a little bit more complicated. Okay. The one consistency that we have is each form is called a 428. The 428 is used to determine taxes. So, for example, an MB 428 is a Manitoba tax form. A BC 428 is for British Columbia, and ON is for Ontario, AB Alberta, so on and so forth. And there you'll look at what your tax brackets. Some provinces, not all, will also have a 479. So here we're showing the Manitoba 479. That is for refundable tax credits. So for example, Manitoba provides a rent credit. If you pay rent, you get an educational tax refund maximum of, I don't even know what it is this year. Last year was $525 for renting. If you have, if you're into green energy, a lot of provinces have green energy refunds for going over into heat pumps. There's there's fertility tax credits, or infertility tax credits. All of those are what we call refundable credits, and they get completed on line 479 or on form 479, right? So I talked like Manitoba has a fertility tax credit, Ontario has a trillium benefit, BC has a climate action tax credit, Saskatchewan has a low income tax credit. Some provinces also have surtaxes or special deductions, such as Nova Scotia's surtax on high earners or Alberta's small business tax deduction, all independent based off of the provinces. When filing electronically, your tax software will automatically transpose and complete the information from your T1 over to those tax forms and complete it for you. However, one thing I promise you out of this course is that you will learn what the tax software does. I don't know how many of you have gone and had taxes prepared for you by other firms. A lot of firms will train their employees on how to enter numbers into a tax software, but will not teach you what they mean. At the end of this course, you will understand what's happening and you'll be able to answer the important questions. One of the most important questions that you will receive is, how come I get so little back this year when last year I got back X amount of dollars? You'll be able to take a look at this year's tax return and compare it to last year's tax return and tell the difference. Something most tax preparation firms cannot do. Now we're going to talk a bit about the CRA digital tools. And I see I'm about an hour into this course, so I think we're doing pretty good on time. Got about 6 slides left, just so you guys are aware. And then we'll get into our frequently asked questions portion. So in 2025, the Canada Revenue Agency's digital platforms have made tax filing faster, more transparent, and more secure than ever before, according to their website. Okay, I try to say that with a straight face. Okay, these tools are designed to help individuals, businesses, and authorized representatives manage their tax affairs efficiently and with confidence. All taxpayers have access to their tax account, called My Account, online. Your tax account online will give you a history of at least the last 10 years of tax returns that you have filed. It'll tell you what your RSP contribution limits are, your TFSA contribution limits are. It'll tell you how much money you owe. You're able to print off notices of assessment from there. You're also able to determine what you're owed in childcare benefits, GST checks, a whole bunch of other things. Now, they are trying to make it better, but they are not perfect. Other items that you're able to get from your My Account is you're actually able to get copies of all of your tax information slips. But I'm going to put a big asterisk beside what I say there, because that's only the ones that your employers have submitted electronically on time without any errors that the Canada Revenue Agency has been able to process and post. So when I say that, let's talk about tax filing deadline. Let's talk about deadlines. So we all know the deadlines for tax slips are when? February 28th, right? Well, you're wrong. T4s, T4As, and T5s are due and must be submitted and sent out to clients by the 28th of February. Now, a lot of companies won't file them and won't prepare them and file them or mail them until the 28th of February, which means what? With our Great Canada Post system, you may not receive it until the 10th, 12th, 15th of March, maybe never, right? Some employers send those tax forms out electronically. If they use a service like Payworks or ADP or QuickBooks or Xero, the employees are required to log in and print their own T4s out. They don't show up in the mailbox anymore, right? But even though the tax deadline is midnight on February 28th, that doesn't mean that the Canada Revenue Agency has received and processed all of those T4s in good order. They may not have received them from all the employers. And while the requirements are to have them there by February 28th, a lot of employers do not meet their deadlines and they choose to pay the late filing penalties to the government for doing it, but there's no compensation to the employees, right? Once the CRA receives the documents, now if they receive them through electronic filing, normally they're processed relatively quickly. However, larger employers and larger payroll firms may send in magnetic tapes or data files to Revenue Canada, which could take weeks or more to file. Banks are really good at doing that, and normally T5s, which show your interest or your investment earnings, don't appear for weeks into March, right? The other thing to note is those are T4s and T5s. There's one other tax return slip that a lot of Canadians get, especially if they're involved in investments, and that's called a T3, a Statement of Trust Return. Trust returns or T3 return forms are not required. If you go back to my chart a while ago, they're not required to be sent out till 90 days after the year end. Okay? So we really need to be careful with that. 90 days after the year end. So let's say that the year end is December 31st. They have until March 30th to send that paper, or March 31st to send those forms out. Most clients that deal with investments technically do not have all of the information or tools to file their tax returns until the first or second week of April, which really comes tight on our filing deadline, giving all of our investment clients in Canada really have 2 to 3 weeks to file their tax return from the time they have all of their information. And in most cases, there's no way to determine that information beforehand. So this becomes a challenge, especially in the tax preparation world, right? So as much as we can go into our CRA account and we can print off all of our tax slips, that does not necessarily mean that all of our tax slips are on there, right? This is a tool for us to use as tax preparers to make sure that we've got what the federal government has on their file that the client may have lost or may not have found. But as with everything, taxpayers can get lazy. Not all of them, but there's a good number of taxpayers that we see come in and they're like, well, why do I even need to, they're like, oh, I don't know, I don't have any of my tax slips. You can get them all from CRA. And we're like, yes, we can. But when we receive those, but if they're not on CRA, we're not responsible for anything else. You should be saving them, bringing them in so we can verify that we have the physical one and the one for the Canada Revenue Agency, and more importantly, that they match. Because sometimes the employers will send information out and then changes will be made and a different form will be sent to the CRA. So it's important as tax preparers to have both of those tools on hand to do our best to ensure accuracy. Right? One of the nicer tools that we have in the CRA account is what's called a real-time notice of assessment. In the past, we used to file a tax return. It would take Revenue Canada 10 days to, 10, 15, 20 days to assess the return, and then they would send out the notice of assessment to the taxpayer by mail. Now, we've seen, going back years before they've gotten as far advanced electronically as they did. I remember I used to do what was called discounting, which means I would do a cashback system. And doing that, the client would come in today and we would check with CRA and we'd say, yeah, okay, you have one T4, we have one T4, that's all fine. We would file the tax return. Well, guess what happens? Another employer would file a new T4 the next day, which means that the taxpayer shouldn't have got money back. The taxpayer actually owes money. However, when we filed it, we weren't aware of the information. When the Canada Revenue Agency went through, got to the tax return and did the assessment, they had the information. They would change the tax return and they would send me no money and they would send the client a bill for what they owe. Then it would be my responsibility to chase down the client and get the money that I gave them that they weren't entitled to. So in today's day and age, with the real-time notice of assessment, when we electronically file a tax return, probably about 98% of the time, we're able to log into the represented client, or the client's able to log into their My CRA account and get the notice of assessment at that point in time. It'll also tell them what date the money is being deposited into their bank account. All right. Just talking about that, and as we go through, there's always going to be some things that I add in, which is one of the reasons why we don't record this or do AI to have these presentations. One of the things to understand is, oh geez, now I just forgot what I was talking about. Oh, direct deposit. When we look back at our stats, 3/4 of Canadians are getting their tax refunds by direct deposit. Here's something the government started last year. The government would send out your notice of assessment, typically 10 days after you file the tax return, and they would say, okay, your tax refund is $2,247. You will receive that in a separate envelope or under separate cover. So you would get your notice of assessment, but guess when you'd actually get your check? 3 or 4 weeks later. So now, even though the assessment is done on time, the government sat on your money for an extra 3-4 weeks. So direct deposit, they will always deposit the money electronically into your account on the day of the assessment. By check, okay, and I'm not making any accusations of anything, but a conspiracy theorist would sit back and say, well, they're holding on to the money longer to enforce or entice taxpayers to hook up to direct deposit, which is actually what is happening, right? So it's always advisable for the client to have direct deposit. Now, as much as we have all these tools, they've pulled a number of tools away from us. So with Revenue Canada, we have the digital tools. There's My Account. That's the account that all taxpayers have. As tax filers, we can apply for a representative ID, and then we can set up a system called Represent a Client, where a client gives us permission to access their tax files. And now at that point in time, we can take a look and see what their tax returns are like online. In the past, up until 2025, we were able to print off a form, explain to the client what that form meant, have them sign it, and then we could electronically submit that form, and we would get almost instantaneous access to the CRA account. So we could go in and make sure that we had all of their tax slips. We could see if they owed money from previous years, and we could do verification, especially for new clients, right? In 2025, they decided that they are not going to allow that. So in order for you as a tax preparer to get access to your clients' files, your clients have to log in to their My Account and go in and approve or provide access to you as a representative, either as a corporation or as an individual. And we'll talk to you about how that gets done. But that's one of the main changes this year that, as a tax preparer, is really going to slow down and affect the accuracy of tax returns that we do for first-time filers. We have a lot of people that don't have the patience or don't want to or don't have the understanding or technical ability to access their accounts. If they've never accessed their accounts, you have to go through a secure identification verification with driver's licenses and a number of other documents, or you have to wait 7 to 10 days to get a security code mailed to you. All of that is going to delay the processing of tax returns for new clients. Okay? One of the other tools that they took away at the end of March last year was the availability for us as tax preparers to enroll our clients in direct deposit. So before, we used to fill out a T1DD with the client's banking information, have the client sign that form to verify that that information was correct, and submit that electronically to the government, and the government would automatically set up direct deposit. Well, they took that away. So now, in order for a client to register for direct deposit, they have to log into their online banking system and register through their online bank, providing they're connected to it. A number of credit unions don't give you that availability, which means the clients have to go into their CRA My account and authorize and set up the direct deposit through there. Okay? There's certain things that, as tax preparers, even if we have representative client access, that we can do on behalf of our clients. Adding or changing bank accounts is no longer one of them. Changing addresses is not allowed for us to do under representative client. Now, why is that? Okay, good question, Stacy. The reason why is that there are bad actors out there. If, I tip my hat to those of you that have registered and are taking the course, because you want to learn to properly represent individuals and Canadian taxpayers and assist them with helping out on their tax return, and you're electing voluntarily to learn and train. Here's one thing I'm going to tell you. You do not need to have any formal tax training, school, or education in order to get an e-file number. In order to get an e-file number, you must be current on your income taxes, and you can't have been charged with tax fraud. If any of those two, if you've never been charged with tax fraud, and all of your tax returns are filed on time and you do not owe the government any money, they will give you an e-file license. But that does not mean you know how to file taxes. So what happens is they supply e-file licenses to people, and these people are not necessarily on the up and up. And I'm going to say we're not talking about the 95%. We're talking about the 5% or the 1%. We're talking about those that are getting social insurance numbers for clients and creating a tax return, putting artificial numbers into a tax return and filing it, and the government takes you the government will take you on your word for that. So I get Joe Smith's social insurance number because his T4 was mailed to my house instead of his. Canada Post delivered it to the wrong address. Has the social insurance number on there. I can go, there's nothing stopping me as an e-filer to go in there, create a tax return with his information, changing the information that's on there, or adding in other tax deductions and whatever else, hitting submit, and now the government will generate a tax refund for that client. Well, guess what? If I put them on direct deposit, I can put my bank account number in there, and I can have that money deposited into my account. If I change their address, I can have that check mailed to me instead of to them. So there's things that because of a couple of bad actors, those of us honest tax advisors, tax preparation and tax advisory companies, the tools that were great for us to use to help represent our clients have been stripped away because of the actions of a couple of bad actors. That's why we've lost access to represent a client to be able to do it, because there were a lot of tax professionals that would just automatically tell the clients or automatically submit the paperwork without even getting it signed. And clients would get letters saying, oh, ABC Tax Company is now an authorized representative. And the clients would say, no, I never did that. And the government said, okay, there's way too much of this going on. We're no longer going to allow tax preparers to do it, right? Instead of regulating the system and making sure people are trained properly, the government is just taking tools away from tax preparers in order to make our jobs harder, right? And now I have some theory behind that as to why. But at the end of the day, we're here to teach you on taxes, so I'm not going to go down that rabbit hole. All right. Now, other access that you can get under here is you can get access to my business account, which is tailored for businesses, sole proprietors, corporations. And in there, you're able to find information on payroll remittances, GST filings, corporate tax returns, and other excise taxes. Represent a Client, I've already talked to you about, is available for us as tax professionals, right? And I've explained all of the pitfalls and problems we have. I'm off my notes here, so I'm just going through my notes, making sure I've got this all taken care of. Okay, so I think I've kind of talked about this enough. And like I said, and now, that one slide was 20 minutes, and I'm sorry it takes so long. Sorry it took so long, but I think that information is important. Right now, I want to kind of take a minute and pause and look at a real world example of how tax returns are completed and what happens. So we're going to talk about my old buddy Wile E. Coyote. Okay, Wile E. earns $25 an hour as a tradesperson. He works the standard working hours in Canada, which is 40 hours a week or 2,080 hours annually. That's $52,000 a year. Now, what happens is his boss offers 20 hours of overtime at Christmas, and the pay is 1.5. So now he's getting paid $37.50 an hour, and he takes, and the pay is $37.50 an hour, and he's offered 20 hours. The offer goes out, and his buddy Joe tells him not to take it. If you work on it, you're going to go into a different tax bracket, and you're going to lose it all to tax. That's what's being told. In reality, as we discussed, Canada's tax system is progressive. Only income over $57,375 is taxed at 20.5%. So when we look at that, right? Bring the slide up here. In this case, only because, out of the extra money that he makes, there's only $109 that's paid at the higher tax rate. So one thing I didn't put on the slide, probably should change that. $37.50 an hour times 20 hours. $37.5 times 20. Yeah, it's $750. So if Wile E makes $52,000 a year, and he makes an extra $750, which I actually do have here, what is that $750 taxed at? Right? He's going to pay $109 extra in tax because it's taxed at, at 14.5%. And he's going to keep $641 of the $750 that he receives in overtime. So, the lesson to be taken here is that you'll never lose money by earning more. right? Progressive taxation means only the upper portion of your income is taxed at the higher rate, not all of your income. Before overtime, so let's look at this again. Before Wiley's income was $52,000 with about $7,540 in federal tax. After overtime, his income rose to $52,750 and his income tax was $7,649, increase of $109, which means Wiley still keeps 84.5% of his overtime pay. Sorry, I should have been bringing this up here. Okay, so again, let's take a look here. Wiley's real overtime example, forecasting annual income. So I talked about that as if it happened at the end of December. One of the issues with overtime is you may be offered in January and February. And as I mentioned before, we used to do this by payroll deduction books. And you would have a chart if you made between this and this 2 weeks time, this is how much you take off. Payroll software is getting better. So the issue with overtime really is based on forecasting your annual income. Although payroll tax programs advance every day, the actual calculation in your payroll tax software works something like this. Okay? The software looks at your current 2-week income. So how much did you make in this 2-week period of time? They'll multiply that for the number of pay periods left in the year, right? Or the number of pay periods in a year. And that will determine what your tax rates are. They'll do a quick tax calculation, determine how much money they're estimating you're going to owe in tax at the end of the year, divide that back by 26, and that's how much they're going to take off in tax in a 2-week period. Right? That's how payroll software works. So we do have to be careful. If you're starting to work a lot more, when I say it gets advanced, the really good payroll software says, okay, it's now the 3rd week in March. This is how much money you made every 2 weeks, regular pay. We're going to forecast that by the remaining pay periods at the end of the year. We're going to look at how much money you've already made, including overtime. Now we're going to factor in with this extra overtime, what does that do to your tax brackets? And it will make the calculation. So payroll software has made it a lot less noticeable as to the extra tax that gets taken off. But for those people that always found that they had, they may have lost half of the extra money that they made, what they always neglected to forget is that's why they got the couple of $1,000s in refunds at the end of the year. Right? Let's take a quick look at common filing mistakes. And, I've probably touched on most of these, but even with advanced tax software and the CRA digital tools, filing mistakes remain one of the top reasons for reassessments and delayed refunds. Understanding the common errors helps both the taxpayers and advisors maintain compliance and avoid unnecessary penalties. Right? Here's some of your main issues. Missing or incorrect slips. The CRA, though their autofill my return, downloads most of the tax slips, T4s, T5s, etc., from employers and financial institutions. The problem is the timing, especially when you have the eager beavers of the year that are looking for their tax refunds that come and see you before the end of February. They may have their T4 slip, but their employer may not have registered and filed that with the CRA yet. Right? Okay, I went all over that in the last one. Claiming ineligible expenses or credits. Examples of that would include overclaiming vehicle or home office deductions, claiming personal costs as business expenses, or using outdated medical expense receipts. The CRA frequently requests proof which means we need to ensure documentation is clear. So I think at this point in time, I'm going to sort of talk about this. The CRA gives taxpayers in Canada a lot of trust when they file their tax return in order to expedite their processing time. When we file a tax return on behalf of taxpayers, or if a taxpayer does it themselves, either by phone or online or whatever else, CRA's goal is to take the information, process it as it exists on that tax return, and They also do a minor slip matching to make sure that there's nothing missing in their tax information that you may not have included. So they do some small verification, but in most cases, that's why a tax return has instant notices of assessment done within 30 seconds to a minute of filing the tax return. The one thing that we as taxpayers or individuals do not submit to Revenue Canada when they e-file or net file their tax returns is proof of anything. Electronic copies of tax returns, tax receipts, none of that gets submitted to Revenue Canada. In a lot of cases, there's what's called a keying summary and a 14-page tax return. The information that's submitted is 9 lines. Revenue Canada looks at those 9 lines and says, okay, we'll process it based on that. And then they come back to the taxpayer, they come back to us in May, June, July, August, September, October, November, December, even January. We're still receiving requests for proof of medical expenses, proof of vehicle expenses, proof of charitable donations, proof of childcare expenses, right? They have the right to come back and ask you for that. It's called a post-assessment review. So just because the tax return gets filed and the taxpayer gets paid correctly, that doesn't mean that our job is finished, right? One of the biggest areas that we look at is prescriptions. One of the biggest missed tax deductions in Canada is medical expenses. People don't keep all of their receipts for their prescriptions. People don't understand that what they pay for their healthcare premiums through work, if they pay for their own health and dental plans, if they buy travel health insurance, they don't understand that all those are tax deductible. Chiropractor, massage therapy, all of that, they're all medical expenses. And just because our healthcare system didn't pay for it doesn't mean we can't deduct it. The problem is the clients are expected to hang on to all those receipts. A really good tip that we use with all of our clients is, and I've already done it with me, I go into my pharmacy in January and I'm like, okay, the year's over. I want a detailed printout of all my prescription expenses for the year. They give me a 1-page, maybe 2 pages, maybe 8 pages with a listing of all the prescriptions that I got, when I took them, and at the very end, it says, this is how much money there were in total prescriptions. This is how much money the patient paid. This is how much money the co-insurance or the insurance companies paid. So the amount of money that the patient paid is tax deductible. The amount of money the insurance company paid on your behalf is not. Go and get your clients to get the reports. Get your own reports. They are way faster and easier to do. If we're doing tax returns and charging people to do it, if you're bringing me in 150 slips that I have to go through and add up, you are going to be paying me for my time, and it's going to cost you probably about $300 or $400 for me to do it. If you bring me 1 page that tallies it all up, you're going to pay me $3 to do it. So we always want, it's not about gouging our clients. It's about being smart, because at tax time, we do not have the time to go through and gather all of this, right? Other areas are unreported side income. So those side hustles, the gig jobs, that's your Uber, that's this, that's that, that's everything else, and any self-employment. Many new freelancers forget to report income from their side hustles, cash jobs, online platforms. So that's even Etsy, YouTube. If you happen to be, one of those guys that gets enough hits that all of a sudden YouTube starts paying you for advertising and whatever else, you need to make sure that you report that. If you're getting paid from out of country, they won't give you tax slips for it, or you may get a 1099 from the US. Just because it's a US tax slip doesn't mean it shouldn't be reported on your Canadian tax return, right? And in most cases, those type of income need to be completed on a Schedule T 2125, which is a statement of business income. Other issues are ignoring capital gains, specifically crypto transactions, right? Cryptocurrency is now because, a lot of trading companies have now moved over to where you use brokerage houses for cryptocurrency transactions, right? That's in order for the government to track. Here's what gets tracked, guys, and I'll tell you right now, when it comes to dealing with any brokerage houses, they are required by law to file and send in what's called a T5008 to the Government of Canada that tells them how many units you sold and how much you received. So I sold 0.0025 of a Bitcoin and I received $7,000, right? What they're not required to tell the government is how much you paid for what it cost you to buy that 0.0025 Bitcoin. So maybe it cost you 5,000, you sold it for 7, you have a $2,000 capital gain. You need to pay tax on that. However, you don't report it at all. The brokerage house sends in the T005 that tells the government you sold it for $7,000 and it didn't put what you paid for it because they're not required to put that on. The government's going to send you a bill for $2,000 for tax on the money that you made on the entire $7,000. So we need to make sure that we're looking at that. Okay. Other things to look at are things like day trading income. So, if I'm a stockbroker, if I like to go online and I do self-directed investing, if I'm buying, 5, 6, 7, 10 stocks a year and I'm selling them here and selling them there, that falls under investment income. But if my job, or if I'm good enough at the market that I study the market and I'm going in and every day I'm buying 3, 4 stocks, I'm selling 2 or 3 or whatever else, that's called day trading. That's a nature of trade, which means it is a business activity. I now have to file a T2125, right? NFTs, fungible assets. So these are electronic cards, and NFTs, it can be a number of things. Selling them and making money needs to be reported on your tax return, right? Incorrect filing of credits and deductions. So if you incorrectly or duplicate RSP deductions, that's an error, and that becomes a problem. When we talk about RSPs, because the RSP year goes from day 61 of the calendar year to day 60 of the next calendar year, T4s that you receive in January of 2026 must be reported on your 2025. But a lot of people, they may report them on 2025 and forget about them and report them again on 2026, which now you've duplicated the reporting, or you don't file it on 2025 and you hold on to it for 2026. That's an incorrect reporting. It has to be filed on your 2025 tax return, not on your 2026. So we'll get into that and we'll learn rules about it, right? Using outdated forms or software. Well, electronic filing of software will never let you file a tax return using outdated software. But if you're using outdated forms, that becomes an issue. Incorrect marital or dependent status. So changes in your family structure. You know what? You get married, you get divorced, you have a separation, you have birth of a child, there's a change in custody agreements. That affects not only your tax return, but it can also affect your Canada Child Benefits, your GST, everything else. These should all be updated when they happen with the Canada Revenue Agency, not waiting till tax season. So, for example, let's take a look at, okay, I'm a father, my wife and I get divorced. And my wife moves away, and this happens more and more, what I'm finding. The wife doesn't take the kids, I keep the kids. Right? I don't think about it, and I don't report it to Revenue Canada. My ex-wife doesn't report it to Revenue Canada. Well, guess what? She's continuing to get the child care benefit checks because they were in her name, but she doesn't have the kids. So now when I file my tax return, I indicate that I'm separated. I indicate that the kids live with me, da 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 da. They're going to send her a bill and I'm going to get back pay after I go through all the hassle of proving that that's actually what happened. So let's say I get that all corrected. 3 years down the road, so I'm a single parent. 3 years down the road, I meet somebody else and I move in with them. Right? Now, by me moving in with them, I lose my eligible dependent tax credit. I now have to factor in, or let's not say move in. I get married 3 years down the road. I lose my eligible dependent credit immediately. Because I'm married, I now have to get my GST and my child care benefits are all calculated on my net family income, not my net family income, not my individual income. So now I have to bring my spouse's income into effect, and I may be getting paid for child care benefits and GST that I'm not entitled to. And when I file my tax return, guess what? I get a nice big bill. So it's important to make sure that we're always updating those statuses and we're making sure our clients are updating those statuses when it happens. Forgetting provincial tax credits. Many taxpayers miss their provincial tax credits such as rent, tuition rebates, small business tax credits, not knowing the fertility tax credits and everything else. And we will make sure that you have a guideline based off of your provinces, or at the end of the course, we'll have a book together for you of what each province has for on their 479 that we need to be aware of to claim. All right. So that kind of wraps up today. So to summarize, today we've covered the history of Canadian taxation, who is required to file a tax return, what the key CRA tools are, and how to use forms like the T1 and the TD1. We debunked common myths. We examined digital income and emphasized strategic tax planning. We talked about some deadlines, and we started introducing you to applying principle planning, right? Or applying planning principles. Okay. So I think that kind of wraps up the training course here. I'm going to stop the recording, but we're going to get into some frequently asked questions that we have, and we'll make sure that they're posted in the notes after the course on the FAQs. Okay. Thank you very much for attending, and we'll see you guys in 2 days when we take on class 102. Bye now.